Hello traders, welcome to our video series on market analysis. In this series, we'll be exploring 3 essential types of market analysis that every investor and trader should be aware of. Today, we're diving into the first one, technical analysis. Prior to delving into technical analysis, it's crucial to understand the motivations behind acquiring this skill. There are 2 key reasons for this. First, mastering technical analysis is easier. Fundamental analysis requires a high level of proficiency, while technical analysis can be applied to all markets. The learning threshold for fundamental analysis is high, requiring a lot of specialized skills. Additionally, trading agricultural products involves studying climatic conditions and supply-demand factors, while trading metal commodities requires understanding the political and economic situations in the producing countries and so on. These endeavors are not easy tasks for most investors. On the other hand, accurate information gathering for fundamental analysis is challenging. What's more, there is an imbalance in access to fundamental information and data compared to institutions. Second, for novice traders, technical analysis is an important guide to follow. Novice traders are most prone to making random trades or overtrading as they enter the market based solely on gut feelings without any basis. However, if they can correctly utilize technical indicators or technical analysis, beginners can at least learn to make informed buy and sell decisions, especially when it comes to setting stop-loss orders. By using technical indicators to set stop-loss levels, they can establish a simple and clear plan and develop disciplined trading habits. Hence, achieving proficiency in technical analysis is imperative for traders. Then, let's move on to the next part. What is technical analysis? Technical analysis is the framework in which traders study price movement. The theory is that a person can look at historical price movements and determine the current trading conditions and potential price movement. Technical analysis proponents believe that prices can reflect all information in the market, including economic cycles, social events, natural disasters, wars, and various fundamental factors. Ultimately, all of these fundamental aspects will be reflected in the price changes of the underlying asset. Therefore, by examining the price chart, one can visually observe the changes that have been synthesized from the fundamental factors. This is why there is a saying that the stock market is the barometer of the economy. When discussing technical analysis, it's essential to consider the 3 fundamental hypotheses that underpin it. Now, we will introduce the 3 assumptions of technical analysis. Assumption 1. Market behavior reflects everything. This forms the foundation of conducting technical analysis. Technical analysts believe that market participants have already taken into account all factors influencing market prices when making trading decisions. Therefore, studying market trading behavior is sufficient to understand the current market conditions without the need to concern oneself with the underlying influencing factors. Price movements already encompass or digest all market information unknown to speculators, including policies, supply and demand dynamics, overall investor sentiment, and even unexpected events. The combined force of these factors shapes the price trends at that moment. Assumption 2. Price evolves in a trending manner. This is the most fundamental and core factor in technical analysis. The concept of trend is central to technical analysis. According to the laws of physics, a trend will continue until there are signs of a reversal. In fact, while prices may fluctuate up and down, ultimately, there are signs that they are moving in a certain direction. This is, of course, an application of Newton's law of inertia. Therefore, technical analysis seeks to use chart patterns or indicators to identify the current price trend and detect early signals of reversals, enabling traders to seize opportunities and profit. Price evolves in a trending manner, but it doesn't mean that the market is always in a trend. Assumption 3. History repeats itself. This consideration stems from human psychological factors. Trading is fundamentally a pursuit of profit, and this motivation remains constant, whether it's yesterday, today, or tomorrow. Therefore, in this psychological state, human trading behavior tends to follow certain patterns, leading to historical repetition. As a result, the ways in which prices have changed in the past may continue to occur in the future. This is worth studying for investors, and by employing statistical analysis methods, they can discover regular patterns and formulate effective trading principles. Based on the three theoretical foundations mentioned above, technical analysis has become an effective method for assessing market trends. However, there has always been debate about the validity of these three major assumptions, with different opinions held by different individuals. For this reason, while conducting technical analysis, it is advisable to also engage in some fundamental analysis and other forms of analysis to supplement its limitations. Having gained an understanding of the fundamentals of technical analysis, let's proceed to explore the merits and drawbacks of this analytical approach. First, the advantages of technical analysis. Simplicity. It often uses graphical representations, making it easier to follow than complex financial statements. Technical analysis utilizes various charts, eliminating the need for extensive data collection. Objectivity. As charts reflect multiple factors, they provide traders with intuitive and objective insights. Buy and sell signals depicted on charts are not influenced by subjective preferences. Insightful. By analyzing historical price trends, investors can make informed decisions and adapt to market trends accordingly. Second, the disadvantages of technical analysis. Subjectivity. Technical analysis is not a comprehensive and scientifically rigorous theory. It has evident experiential and subjective elements. Limitations. Various indicators are processed results, which may lead to a loss of original information. Lagging signals can cause a significant delay compared to market movements. Obsolescence. As methods of technical analysis are constantly evolving, when they become widely used, they can easily become ineffective. In conclusion, understanding technical analysis can greatly enhance one's ability to succeed in trading financial markets. While technical analysis provides advantages such as simplicity and objectivity, it is important to acknowledge its limitations, such as subjectivity and potential signal delays. To maximize success, it is wise to combine technical analysis with other analytical methods and remain adaptable in the ever-evolving financial landscape. We will continue delivering valuable trading knowledge content. Please stay connected to our channel for updates. Thank you for tuning in. In the upcoming video, we will be discussing fundamental analysis. Additionally, we welcome your thoughts and feedback on our video in the comments section.